The accounting equation. This may sound complicated, but today we're going to break it down and make it easy to understand. The accounting equation can also be known as the balance sheet equation. It represents the relationship between a company's assets, liabilities, and equity. The equation is assets equal liabilities plus equity. It means that the assets are equal to the company's total liabilities and equity. Now we'll break down each section of that equation. We'll start with assets, which is one side of the equation. Items included in assets are cash, which are bank accounts that the company owns, accounts receivable, or invoices billed to customers not yet collected, inventory on hand not yet sold, and fixed assets, which could be vehicles the company owns or equipment like computers, or if the company is a manufacturing company, large machinery, any kind of equipment like that. Now we'll move on to the other side of the equation, which is liabilities and owner's equity. We'll start with liabilities. Items included in liabilities are accounts payable, which are bills the company owes to vendors, loans and capital leases that the company owes, any deferred revenue, which we'll cover in a later video. Sales tax payable can be a liability. With sales tax payable, you collect the sales tax when you make the sale, and then you remit that sales tax as the company. All of these things, among others, can be included in liabilities. Additionally, on this side of the equation is owner's equity. Owner's equity can include owner's contribution, or money the owner contributed to the company. This can also be paid in capital. Owner's distribution, or draws from the company to the owner, and any retained earnings from prior periods, which we'll cover in another video as well. The accounting equation is the cornerstone of double entry bookkeeping. This system basically means that everything on one side must equal everything on the other. So if you enter a debit on one side, then there must be an equal credit on the other side. And we'll cover debits and credits in another later video as well. This type of accounting ensures that your books are accurate and that everything balances. Financial analysts and investors will use this to determine a company's health and performance. They can use this to determine leverage and solvency, which we'll discuss in a later video, but this can help them determine if the liabilities are extremely high compared to the assets, then maybe the company is too far leveraged. We can also see changes over time, identify trends to determine a company's financial growth, position, and efficiency. The accounting equation is the foundation of the accounting principles and is your key to financial insights. Don't forget to like and subscribe.